All right, Steve here. Today, I'm going to pull back the curtain on my personal strategy for controlling those super expensive stocks, but for just a fraction of the price. It's called the poor man's covered call. And honestly, it's my absolute favorite way to leverage a small account. Okay, let's get into it.
I hear it all the time, right? Traders see these monster stocks, the Teslas, the Nvidias of the world, and they just think, I'm priced out. I can't play in that sandbox. They think you need a massive account just to get your foot in the door. Well, I'm here to tell you that's just flat out wrong.
So let's talk about the big problem, the elephant in the room. To buy just 100 shares of a stock trading at, let's say, $500, well, you do the math. That's $50,000 in capital just for one position. For most people, that's a massive barrier. It's a non-starter. It ties up all your cash and, frankly, exposes you to a ton of risk.
So how do we get around this? How do we play in the big leagues without the big league bankroll? Well, this is where we get smart. We get creative. We don't buy the stock. Nope. Instead, I create what I call a synthetic stock position. This gives me all the same upside as owning the shares, but for a tiny, tiny fraction of the cost.
Now, the cornerstone of this entire strategy, the absolute foundation, is something called a Leaps call. That sounds kind of complicated, right? Long-term equity anticipation securities. Forget all that. It's really just a fancy name for a call option that expires way, way out in the future. We're talking at least a year, sometimes even more. And that huge amount of time is the key, because it makes the option behave almost exactly like the stock itself.
And this, right here, this is where the light bulb should be going off. Just look at that difference in capital. 50 grand to buy the shares outright versus, maybe 5 or 6 grand for one Leaps call that controls the exact same 100 shares. That is insane leverage. It completely changes the game and frees up your cash for other opportunities.
All right, so let's get into the nitty-gritty, the actual mechanics of how this works. It's a dead simple two-step process to set this up right. This is my exact playbook, every single time.
Okay, step 1. We go way out in time, at least a year, and we buy a deep-in-the-money call option. I'm always targeting one with a delta around 0.80. Now, all delta means is that for every $1 move in the stock, our option is going to move about 80 cents. See? It acts just like the stock. This is our synthetic stock, our long leg. Then for step 2, we come all the way back to the near term, the current month, and we sell a call against it. For this one, I'm targeting a 0.30 delta. This is our short leg, and this is our cash machine.
So take a look here. This lays it out perfectly. You're looking at 2 different expiration dates. Way out there in the future, that's where we find our 80 delta call. That's our long leg, the one we buy. Then we look at the near-term expiration, usually less than 30 days away, and we find that 30 delta call, and that's our short leg, the one we sell to collect that nice premium.
So, we've got the position on. Now, how do we get paid? Let's talk about the engine that makes this whole strategy profitable. This is where the real magic happens, and it all comes down to the passage of time.
I want you to think about it like this. It's a great analogy. That long-term Leaps call you bought, that's like a piece of property you own, a house. And by selling that short-term monthly call against it, you are basically renting out a room in your house. You're collecting rent from the market month after month after month, and that income helps pay down the mortgage, paying down the initial cost of your Leaps.
The force behind this rent collection is a concept in options we call theta, or more simply, time decay. See, every single option contract is like a melting ice cube. It's a decaying asset. As it gets closer and closer to its expiration date, it loses value, assuming nothing else changes. Our goal is to put this decay on our side.
And this right here, this is the secret sauce. The short-term call that we sold has very high theta. It's melting fast. And since we sold it, that decay is our profit. It goes right into our pocket. Meanwhile, our long-term Leaps call, it's so far away from expiring and so deep in the money that its theta decay is tiny. It's barely melting at all. We've basically set up an unfair fight where time is firmly and powerfully on our side.
Now, this strategy is incredibly powerful, but listen up, because it's not a free lunch. It's not without risk. And there is one critical, non-negotiable rule you absolutely must follow to protect yourself and make sure the trade is structured for success.
I've seen people get this wrong so many times, and it is painful to watch. It can turn what should be a winning trade into a loser. So, what is it? What's the one mistake you absolutely cannot afford to make with this setup?
All right, here's the rule. Write this down. The width between your strike prices must be greater than the net debit you paid for the whole position. Let me say that again because it's that important. The potential profit from the spread has to be more than what you paid to get into it.
If you get this wrong, a huge rally in the stock, the very thing you were hoping for, could actually cause you to lose money. So please always do the math before you place the trade. Okay, so we've covered the problem, we've covered the solution, we went through the two-step blueprint, and we covered the one critical rule you can't break. Now, let's put it all together and see how this actually looks in the real world.
So you're ready to see how I take this exact setup on a $500 stock? We're going to walk through a real-world example so you can see step by step how I use this very strategy to turn what might be a small account into an absolute powerhouse.